Welcome to the TNR channel. Today, we're talking about Social Security, and why you can't afford to ignore it before December 31st. The choices you make now can impact your retirement income for the rest of your life. This isn't just paperwork, it's your independence and security. We'll break down the must-know rules, eligibility ages, earnings limits, spousal benefits, and the cost of living adjustment. What you don't know can cost you big. So grab a notebook, silence your phone, and let's get started. You're too smart to leave money on the table. Let's get right to it. Deciding when to claim Social Security is one of the most important financial choices you'll ever make. It's not just about picking an age, it's about understanding how your decision will impact your income for the rest of your life. Your eligibility age is the foundation of your Social Security strategy. For most people, that means you can start claiming benefits as early as age 62. But here's the catch: claiming at 62 comes with a permanent reduction in your monthly benefit, up to 30% less than if you waited until your full retirement age. That's a significant cut, and it lasts for the rest of your life. Every single month you wait to claim, your benefit grows. It's like giving yourself a raise, just by being patient. If you have the flexibility, waiting is usually the smarter move. It can mean a much more comfortable retirement, especially as living costs rise. If you delay claiming until age 70, you'll receive the maximum monthly check possible. For every year you wait past your full retirement age, your benefit increases by about 8%, a guaranteed return that's hard to beat anywhere else. That's a guaranteed return you won't find elsewhere, and it's protected from market ups and downs. But don't just ask, "Can I claim?" Ask yourself, "Should I claim now, or should I wait?" The answer depends on your unique situation. Consider your health, your life expectancy, your other sources of income, and your spouse's needs. If you're in good health and expect to live a long life, waiting can pay off big time. But if you need the money now, or have health concerns, claiming earlier might make sense. It's also smart to run the numbers or talk to a financial advisor. They can help you figure out your break-even point, the age at which waiting starts to pay off compared to claiming early. Remember, claiming early can also reduce survivor benefits for your spouse. If you're the higher earner, waiting to claim could mean a larger benefit for your partner if you pass away first. The Social Security Administration won't give you personalized advice. It's up to you to make the best decision for your future. Before the year ends, log in to ssa.gov and check your statement. Compare your estimated benefits at 62, your full retirement age, and at 70. The numbers might surprise you. Let those numbers guide your decision, but also think about your lifestyle, your goals, and your family's needs. The difference between claiming early and waiting can mean hundreds, or even thousands, more each month for the rest of your life. Over decades, that adds up to a huge difference. More income could mean more freedom to travel, pursue hobbies, or help your loved ones. It's about creating the retirement you want. So, take your time, weigh your options, and make a choice that secures your future, not just your present. Your retirement is worth the careful planning. Let's clarify full retirement age, or FRA. It's not the same for everyone. FRA is when you're eligible for 100% of your benefit, and it depends on your birth year. Born in 1954 or earlier, your FRA is set. Born later, it's likely between 66 and 67. Claiming before FRA means a reduction. After FRA, you get a bonus. Don't guess. Find your exact FRA at ssa.gov. This number is crucial for your planning. If you claim early, you could lose up to 30% for life. Wait until 70, and you could get a 24% bonus. Know your FRA. It's the anchor of your Social Security strategy. Get this wrong, and your whole plan could fall apart. If you're thinking about claiming Social Security before your full retirement age, but you still plan to keep working, there's an important rule you need to know: the earnings limit. This rule can have a big impact on your monthly benefit, and it often catches people by surprise. For 2023, if you earn more than $21,240 from work, Social Security will withhold $1 from your benefits for every $2 you earn above that limit. This applies to wages and self-employment income, not investment or pension income. The earnings limit is adjusted each year, so it's important to check the current numbers. While the money that's withheld isn't gone forever, Social Security will recalculate your benefit at full retirement age. Losing that cash flow now can be a real challenge, especially if you're counting on those monthly checks to pay your bills or cover living expenses. The rules change a bit in the year you reach your full retirement age. During that year, the earnings limit is much higher, $56,520 in 2023, and the penalty is less severe. $1 is withheld for every $3 you earn above the limit, but only for the months before your birthday month. Once you reach your full retirement age, the earnings limit disappears entirely. You can work and earn as much as you want, and your Social Security benefit won't be reduced at all, no matter how high your income. If you're earning a good income, it's often smarter to delay claiming Social Security. Waiting not only avoids the earnings penalty, but also lets your benefit grow, potentially giving you a much larger monthly check for life. Before the end of the year, take time to estimate your total earnings. Are you likely to go over the limit? If so, it's better to know now than to be surprised by a reduced benefit later. If you're close to the limit, consider options like reducing your work hours, shifting some income to the next year, or even suspending your Social Security benefits temporarily. You can also contact Social Security to discuss your situation and avoid any unexpected surprises. The key is to be proactive, not reactive. By planning ahead and understanding how working affects your Social Security, you can make smarter choices and protect your retirement income. Social Security isn't just about your benefit, it's about your family's security too. Married, you may be eligible for up to 50% of your spouse's benefit, claiming before your FRA reduces that amount. Divorced after 10+ years, you may still claim on your ex's record. No impact on their benefits. Survivor benefits let you claim your late spouse's full benefit, but early claims mean reductions. Smart planning can let you switch between survivor and your own benefit for maximum income. The higher earning spouse's decision affects both partners, especially survivor benefits. Couples, review your statements, discuss health and longevity, and plan together. The right strategy can mean thousands more over your lifetimes. Don't leave this conversation for later. Act before year end. Think Social Security is tax-free. Not always. If your combined income, AGI plus non-taxable interest plus half your benefits, exceeds $25,000, single, or $32,000, married, up to 85% of your benefits could be taxable. This isn't an 85% tax rate, but a portion of your benefit is added to your taxable income. These thresholds haven't changed in decades, so more retirees are taxed each year. Year-end is the time to review your income sources, IRA withdrawals, pensions, investments, and see if you'll owe taxes on your benefits. Consider Roth accounts for future tax-free withdrawals. You can have taxes withheld from your check or make estimated payments. Just don't ignore it. Plan now to avoid a surprise tax bill in April. The COLA is your annual Social Security raise, protecting you from inflation. It's based on the Consumer Price Index and announced each October. A higher starting benefit means bigger dollar increases from each COLA. Over time, this compounds. Waiting to claim can mean much more income as you age. Check your COLA notice and new benefit amount each year. Remember, Medicare premiums may offset some of your raise. Social Security's inflation protection is unique. Private annuities can't match it. The longer you wait to claim, the more you benefit from COLA's compounding effect. December 31st is a hard deadline for key Social Security actions. This date marks the end of the year and the final opportunity to make crucial decisions that can impact your financial future. Missing this deadline could mean delays or complications in receiving your benefits. If you want your first check in January, you must be eligible for December benefits. This means ensuring all your paperwork is in order and submitted on time. The Social Security Administration needs to process your application, and any delays could push your first payment to a later date. Claimed benefits in the last 12 months and changed your mind. You have a one-time do-over. File SSA 521 and repay what you received. This can be a valuable option if your circumstances have changed, or if you made a hasty decision. However, remember that this is a one-time opportunity, so consider it carefully. If you're working and claiming early, update the SSA with your earnings estimate to avoid overpayment headaches. Overpayments can lead to complications and the need to repay benefits, which can be stressful and financially burdensome. Keeping your earnings estimate accurate helps ensure you receive the correct amount. Review your income and consider moves like delaying IRA withdrawals or doing a Roth conversion to manage taxes. These strategies can help you optimize your tax situation and potentially save money. Consulting with a financial advisor can provide personalized advice tailored to your specific circumstances. Update your address and bank info with SSA to avoid payment issues. Incorrect information can lead to missed payments or delays, which can be frustrating and disruptive. Ensuring your details are up to date helps maintain a smooth flow of benefits. Pull your Social Security statement from SSA.gov and check for errors. Missing earnings can lower your benefit. Correct mistakes before year-end. This proactive step can prevent future issues and ensure you receive the full benefits you're entitled to. Review your claiming strategy, earnings, and tax situation now. Taking a comprehensive look at your financial picture can help you make informed decisions and avoid surprises. This is especially important as you approach retirement. Don't let the year end without taking these steps. Each action you take now can have a significant impact on your financial well-being in the future. Make a checklist and ensure you've covered all your bases. Your retirement security depends on timely, informed action. The decisions you make today will shape your financial stability for years to come. Don't leave it to chance. Take control of your future. Take control before the clock runs out. The end of the year is fast approaching, and now is the time to act. Don't wait until it's too late. Make sure you've done everything necessary to secure your benefits and financial future. You've got the knowledge, now take action. Pull your Social Security statement, check for errors, and make a plan. If you need help, consult a qualified advisor, subscribe for more tips, and share your questions below. Here's to a secure, confident retirement built by your smart decisions today.